We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is James Anderson from SDBullion.com. Thanks for joining me today, James.
It's a pleasure, Tom. Thanks for having me on.
Great to have you back. So what have you seen for bullion demand now that we can really look at 2020 as a whole? And tell us about some of the changes that the US Mint and even the Comex have had to implement in order to keep up.
So there's a few questions intertwined there. So I suppose we start with last year, pretty much when the viral crisis hit in March. Obviously, we had spot prices kind of crash to the floor as a lot of leverage traders were going for cash and selling off their positions. So you had spot prices drop, and those who were in the bullion market saw spot prices fall, yet the physical premiums started to gap out, stay high. So we had a situation last year for our company. It was a record. It was a record for virtually any company that was in the industry and doing the job right, where people buy from their website and they deliver very quickly. So we had a record year last year in terms of volume and sales and such. So, and that was industry wide. It wasn't simply us. And this year, thus far in January, the demand has been very high. It's still at a record pace versus any January prior. Remember last year, though, January 2020 was pretty normal. The financial market was moving fine, and people were kind of, they weren't taking what was happening in Wuhan seriously at all, nor the effects that could come from it. So at that time, things were somewhat placid, and so. Thus far this year, it's been very heavy, the volume and the interest in bullion. So in terms of what the changes are at the Comex, has been many. I don't think people understand fully, mostly how the Comex works. It's pretty sophisticated to understand how that market works if you don't work in it. Basically, it's a very leveraged derivative market. It was set up in 1974. If you go back and look at the U.S. cables that WikiLeaks founded, they founded cables that showed that the U.S. Treasury conspired with London gold dealers in 1974 to create a derivative exchange for gold, because they were worried at the time gold was about to be re-legalized in quotes, because obviously it was confiscated in 1934, when they devalued the dollar by about 70% and it kind of screwed over the people that gave up their gold. Another small factoid about it is that the majority of people didn't hand in their gold to the Federal Reserve. Those gold pieces are still around, and they're still sold as semi-numismatic gold coins. So they're not that rare. Anyways, the point of it is that 75, the U.S. Treasury was concerned because the gold price was rocketing. It was $200 roughly, and it had begun the decade at 35 because it fixed at that artificially low price. And so they had these WikiLeaks cables show that they were conspiring with London gold dealers about how to come up with a market, where a derivative market that would be outsized enough where they could inject enough price volatility to discourage people from actually owning physical gold. And that was the London dealers' recommendation, was to create an outsized derivative exchange where you could force and move price whichever way you felt like. And so subsequently, 75, the Comex began trading. And you saw the price of gold go from 200 to roughly 100. The thing that happened, though, is that I don't think the Comex was as sophisticated as it's become, and the price went from 100 back to about 850. They more or less lost control by January 1980, and so they learned a lot of things since then. I think we're in the second era now, from the mid 80s till now, of price suppression. It comes through a few prongs, Comex being one and LBMA being another. But the changes last year in the Comex were epic in terms of what types of brands and bars that they allowed for good delivery. Good delivery is simply, what are the rules for what kind of bars you can use if someone forces delivery under contracts. It's a very small percentage. It's happening more and more now, but it's still a small percentage. It's usually single digits typically. It used to be like 1% or less would be settled for, a delivery in quotes. And in order to settle those deliveries, you have to have a certain brand of gold bar, and it has to be under this, certain stipulations in terms of size, et cetera. We had a situation last year where the price and premium for Comex gold and silver was so much higher than what was happening in London that it was just sucking all the physical gold and silver out of different places into the United States. We had huge imports of gold last year and silver as well into the United States. Is just, I mean, I think it was over 600 tons of gold physically came into the U.S. And I mean, that the fact that that was happening shows that there was demand from probably family offices in the Comex that were looking to get some allocation to gold because, you know, they maybe don't want to have GLD and they want to have something where they could lever up and use Comex perhaps. But that was what was happening. The one thing that hasn't happened yet, we have not seen enough withdrawals fully out of the Comex. I don't think these family offices understand the counterparty risks they're running, and they don't understand completely the fact that a lot of these a lot of the underlying fund, the fractional reserve holdings that are supposed to be in the Comex, are not necessarily audited, or they're not fully audited by third parties. They may be audited by by, for instance, Brinks New York. I mean, I would trust the data that they're saying is, what's in those reserves, but there's some banks involved too, and I don't trust them for anything, So there's a lot of banks involved in the gold and silver Comex markets that are supposedly fractional reserve warehouses that hold X, and it's dubious pretty much anything that these companies say. So it's a situation right now where the Comex has become theoretically almost a physical delivery exchange. If you look at the amount of volume that was happening last year in 2020 into this year, 2021, there's been a huge amount of delivery that's been happening, more so than ever. I mean, record sizes. And the fact that the Comex literally had to start bringing on Chinese branded Hallmark bars, Russian branded Hallmark bars, Turkish branded Hallmark bars. I mean, Turkey that's like the capital of blood gold right now in 2021. That's where, if you have narco gold, that's probably where you're going to go and take it. I mean, Venezuela probably has a direct line to a Turkey refiner with their gold, right? So, I mean, it shows you how desperate it's gotten. And also the underlying, they brought out this thing called the 4GC contract last year, which is this 400-ounce gold bar contract. And I think it was an excuse because if you look now, I mean, the volume amount of people that are trading this derivative, it's still nothing. It's like a handful of people. No one's trading it. The reason they brought it in was so they could probably use the reported amount of gold that was sitting over in London as a counter reference to how much is fractionally reserved underneath the Comex. So now if you go and look, the Comex looks like it's got a lot of gold in its fractional reserve underlying it. But if you actually try and take delivery and withdrawal from it, and everybody started doing that, I don't think the amount that they claim to have would actually stand. I think it would really be a problem within a few delivery cycles if people really started withdrawing out of that system. So I don't buy, as much as they claim is underlying that reserve. I don't buy that. I think it's a very small fraction of what they claim is really there.
So as we're talking about, new records being set, even despite the lower silver price, last week we saw the biggest one-day capital flow into silver derivatives. So can you tell us more about this? And is this a sign of retail money and attention starting to come to this space? How big was this inflow compared to the annual production of silver, to just give us an idea of how monumental of a day that was?
So it was a one-day inflow into mostly SLV. And SLV, for those who are listening, probably know that it's the largest silver ETF, the custodian of which is JP Morgan. So, trusted as far as you can throw JP Morgan, I suppose. But it was a large inflow in one day. It was over 500 billion notional, and that's just over 20 million ounces of silver. And where they're finding 20 million ounces of silver is likely with JP Morgan. And JP Morgan is my hunch. If the SLV is actually keeping up what they're supposed to have, my bet is that they're probably leasing it from JP Morgan at exorbitantly high rates. I think they're probably paying through the eye to do it. Now, I can't prove that because they don't publish these lease rate chart. What lease rates you find are usually published from London, and Lord knows what they're using for those lease rate data points. It's probably not JP Morgan and iShares. It's probably not the data that's going on there. It's probably some other source. So it's hard to say exactly how it's happening, but I'm not sure anyone else has 20 million ounces of silver sitting around that maybe JP Morgan does, because they've been, if anyone's been paying attention since the 2010s, they've been siphoning, it seems, a lot of silver out of SLV for their own account in London. We don't know exactly how much they have, but they've also grown a huge warehouse in Comex where they're over half of the underlying silver in the Comex warehouse. So they went from having 0 ounces of Comex warehouse silver when they were short squeezed in late 2010 and early 2011. And they figured out, oh, wow, we got short squeezed and that was scary. We should probably have a huge warehouse full of silver to be able to handle this if it ever happens again. And they went from having no Comex warehouse silver to having almost 200 million ounces under the house account. It could be a portion of that is theirs, and a large portion could be their clients, et cetera. But the bottom line is it went from 0 to 200 million ounces, which is huge. 200 million ounces is much larger than any size physical storage that Hunt's had. It's like 2 times what they ever had. And I think Warren Buffett at one point had maybe 130 million ounces when he went long in the late 90s. So, I mean, it's a huge amount, and we still don't. I mean, there's people who speculate what they have in London, but it's probably in the hundreds of millions of ounces already. And look, the bottom line is last year, SLV had a huge inflow, and the amount of demand that went into ETFs and just silver investments alone was over 500 million ounces. And it's like, well, where the hell did they get 500 million ounces? Well, obviously in the 2010s, there was a lot of silver that was mined, and there are a lot of people who've been holding it since. And so they've probably been servicing a lot of this demand with high lease rates. That's my hunch. I mean, they're making probably a good premium on that. But the question is, how long can that last? You give me a couple more years where it's 500 million ounces or more of demand for investment silver, you're going to see the spot price rocket. You're going to run into a situation where, sorry, we don't have any more silver to lend you. And now what has to happen is the spot price has to start going exponential to drag silver into this market, because physical is going to be the thing that actually settles. Every year you have about 900 million ounces of new silver coming into market. If you add in recycled silver and new line silver that's mined, 900 million ounces, okay? And so just in one day alone last week, over 20 million ounces were put on a silver derivative bet, essentially, so an SLV bet. Now, if you look at the 1 week total, it was like 30 million ounces almost of demand for that 1 week. And if you look at the bars in the last year, that's second only to like the bars that happened, I believe, in March. If you look at the chart, I could send it to you afterwards so viewers can see, but it's still healthy. It's large. It's not like this outlier idea that, 2020 was 2020 and people made bets when the spot price fell and it's all going away. No, it's because people know, that there's going to be more easing, more explosion of M1, M2. There's going to be more free MMT type handouts of currency coming. And so that's the bets that are being made. I believe the question is, okay, who are making these bets? Who are these people making all these silver bets, and what's the timing? Because I think we're going to see is a momentum trade. Once silver starts to blow through 26 and beyond 30, you're going to start seeing momentum traders come in here too, and they're going to be pushing it as well. So you're going to see a big influx of more bets being placed because people want to get time value money. They're going to want to make sure they get their return quicker than some people are willing to wait.
Mm-hmm. So on a recent interview I did with Michael Oliver, he stated that he expects a $200 silver price. And you recently posted a chart that was coincidentally targeting a $201 silver price. So can this be instructive to us on where we could see silver go?
So the chart is a chart that's from Nick Lard's goldchartsrs.com. And it's a chart that has 3 different lines. And the 3 different lines, the top one is the Eastern price of silver. That it basically takes the Eastern price of silver from 1970 all the way to 2021, and it compounds the data, just adds it up every day as it goes on. Okay. And so it doesn't take into account Western trading for silver. It takes into only the Eastern world's trading for silver. And it also has a spot price fix, which is a red line. And it also has a black line, which is the Western world or sometimes New York trading hours, et cetera. And so what this thing shows is that for just over 50 years, the price of silver in the East is just over $200 an ounce already. And that's just compounding. And so there's people who try to explain it away, and they'll say, oh, that's because the Eastern world hedges with London or something like that. And it's like, the Eastern world can hedge during their trading hours too. And they buy derivatives, they do hedging at the same time. It's not like they have to wait for London to do hedging. This makes no sense other than the fact that the Western world has been manipulating a lot of times and suppressing the price of gold and silver for very real reasons. I mean, if you have a fiat currency regime and you are a dominant fiat currency regime and you are dominating the financial world in terms of plumbing, wouldn't you want to be able to dictate the price of gold and silver and make sure that it stays kind of artificially low so you can get away with what you've been doing? I mean, it's as simple as, I suppose you really have to understand how the price is discovered for gold and silver for you to understand how that makes sense. Because once you understand how it gets discovered, you understand how easy it would be to dictate terms and make it move whichever way you'd want. And for the most part, the last 5 decades, it's been the hope of the financial powers that are to keep precious metals suppressed, keep them in their place. You don't want them running out, because then the financialization, enriching yourself very quickly, that game gets that game ends essentially. And people who work for a living, who do honest day's work, they actually have to, get paid a better living wage. And it's a lot harder to suppress their wages if you let the fiat financialization go away. So, I mean, we're in a situation right now where a lot of the prices we're told are just flat out ridiculous. And there'll be a comeuppance for that. And that's mainly what my bullion bet is about, is the fact that we've been told incorrect data for a long time about the cost of money, long time about the real value of things and how much something is worth today versus what it's likely worth tomorrow based on the basic arithmetic of what the debt situation is and the promises we've made and when it all comes due. And it actually comes due this decade and into the next. So the timing of these bets is pretty simple. It's the fact that next 2 decades, a lot of these lies are going to come undone.
Mm-hmm. So you were highlighting in a recent video that the silver price is very near all-time record highs in Mexican pesos. So what does this mean for the producers in countries like this? And does that in any way affect them negatively when selling, for example, into an American dollar market?
So for Mexican silver, I would worry a little bit if I was an investor for, Mexican silver mines, gold mines, just about security. In the last few years, there's been a lot of robberies that have happened at some of these mines where airplanes come in and cartels steal ore. I mean, it's been small stories of this, but this could become a lot larger of a trend in the coming years, especially as gold and silver start growing in value. The main point of that is essentially, look, the majority of silver coming out of the ground comes out of Mexico. About a fourth of all new line silver comes out of Mexico. So the fact that they're about to run into record prices in silver is not surprising. I mean, India is the same story. India, on the other side, Mexican being the supplier, India being a big demand component. Mm-hmm. India has been gone out of the demand component for the last year or two with a lot of the viral issues and situations with their wedding seasons and such. The demand in silver has been nowhere near what it was on average in the 2010s. On average in the 2010s, they would demand about 170 million ounces of silver on average. But there were years where they did over 200 million ounces of demand in just 1 year alone. And so you have a situation where Mexico's basically making about the same amount that India typically wants, right? And they're both on the cusp of having record high prices. Well, the situation, I think, is what you're going to have is you're going to see there's going to be more supply coming out of Mexico because the price is going to be rising. India is going to be wanting more because gold is very expensive in rupee terms right now. And what you're going to end up seeing is the true situation where poor man's gold plays out, where Indian farmers will rather just hold silver instead of gold because they get a lot more for their rupee. Mm-hmm. And so you're going to see that again, I think, play out. It's just a question of getting through these, probably this year, and this year will probably be another stunted in terms of silver demand, because I would imagine their wedding season will be stunted by the viral issues ongoing. But, come back 2022, 2023, 2024, if you have all this Western silver demand in terms of investing, and then India comes in as well and wants their silver, I mean, it's going to be a real catalyst for spot to have to climb higher. So it's pointing out the fact that we are really on the cusp of some really big moves probably for silver.
And speaking of one of those really big moves, you wrote another article recently that if the start of 2011 was a harbinger of what's to come, we saw fiat M2 supply double, and it was also correlated with a doubling of the silver price. So what are the chances of this happening again?
So in 2011, you have M2. I'm just going to look at the chart real quick so I speak to it. M2 was just over 8 trillion. And now M2 is about 19.5 trillion, and it's going up fast at a fast rate. In percentage terms, this past year-on-year rate of change, M2 is up 26.3%. There's nothing even comes close to that in terms of rate of M2 growth. I mean, you could go back to the financial crisis and look, at times where it's paying maybe 11% for short snippets of time. In the 70s, there was times where it was in the low teens. But here we are. With an M2 of roughly, we started just below 16 trillion, and now it's at 19.5 trillion. And look, the M2 is like one of the things that you use in terms of trying to gauge if the fiat M2 pile is that large versus the gold reserves that the country claims they have. If you have to go back to gold because there's a crisis in confidence, well, what price does that gold reserve have to be worth to make those fiat Fed notes to back it and give them some credibility, give them some semblance of confidence for the average person. It's a very, very high gold price. I blush to say it because it just sounds ridiculous. It's well over $10,000. I mean, I think it's theoretically easy to say gold at 2,000 is very cheap, given the fact of what we're doing to our M2 supply and what we're heading towards in terms of a debt crisis, a crisis in what we can actually pay, and having to rig interest rates and fix them and keep the bond market trapped if we run into a high inflationary environment where we're trying to suppress the yields and keeping the bond. I mean, the bond market, a lot of it, they don't have choice. There's nowhere else to go. You're too large of a size. Where else do you put that capital? I mean, being the reserve currency of the world, that means we have a lot of the plumbing of the reserve currency in the world. There's no other options. I mean, the U.S. is one of the largest. It's like half the ball game or more. So it's we're running into a situation where individuals can make those choices, but sometimes institutions are too large to even go anywhere. They're trapped. They've kind of built themselves and painted themselves into a wall. So, I mean, I just look at the M2 supply and I look at what happened in the beginning of 2011. Beginning of 2011, we started out and the price dipped until the end of January. In the first month, it was not good. Price went down, silver and gold. And then all of a sudden it just rocketed further. And it had already had a good run at the end of 2010. So there was just a brief pause where we consolidated around 26 and then just almost doubled in an amount of 90 days. And so I think the point I was making in that video is like, look, silver is on the cusp of blowing out and breaking out, and it can double in 90 days. It's done it before under much weaker fundamental situation fundamentally, and now we're almost twice the size in so many categories. How fast could silver go to 50? It could happen within 90 days, and this time, the drivers are begging for triple digits, not $50 an ounce silver. And technically, if you blow past $50 an ounce silver too, you look at that long-term chart. It's like it's been building for over 4 decades, this cup and handle. And, I know a lot of people think technical analysis doesn't matter, but there's like millions and millions of people out there. It's a self-fulfilling prophecy. They look at that and they think, wow, silver beyond 50. They know about the suppression that's been happening for decades. What you end up getting is you end up getting a trade of momentum that goes the other way, where it starts to get lopsidedly stupid on the upside, right? Mm-hmm. Where silver at $100, $200 an ounce not only makes sense, but it's also like, why aren't we going towards $600, $700, $800 an ounce? I mean, look at how much M2 has been created. These silver dollars certainly have many fiat Fed notes, of value worth, right? So you can get into stupid situations if we get into a highly inflationary environment where confidence is collapsing. I mean, you can make a case for really high nominal terms, but that's a few years from now if things start really going wrong with the confidence in the fiat system. But currently at $26 an ounce, silver is just on the cusp of really doing something special, something that likely will take a lot of people to new places in terms of their wealth. And I know people have been waiting for this for a long time. I've obviously been here talking about this since the last time it doubled in 2011. So, we've been waiting a long time to see this play out, and the bet is still there. I'm not moving that bet. Been patient enough. I'll wait out another three or 4 years for this to play out, I think.
Absolutely. So, James, one of the things that I really like about your Twitter feed and also your videos at SD Bullion is that you post a lot of charts and a lot of great data to really back up these all these numbers that we're talking about here. So, I found another chart that was quite interesting to me, and it was the S&P to gold ratio and the versus, let's say, the S&P to silver ratio. And one would think that they should look fairly similar, yet it looks like the silver ratio is quite a bit lower than that of gold's proportionally. So is this showing us just how undervalued silver is yet? And what is your opinion of what could be causing this disconnect?
So every time I look at those long-term S&P or Dow versus gold, S&P versus gold, or S&P versus silver, or Dow versus silver, I always look at them in a long-term frame. I think you got to start with, the full fiat currency era from 1970 till now. So that's 51 years of that. That's probably the most important data you need to look at. 1980 was obviously a situation where gold, they lost control of the Comex. The U.S. Treasury wanted to keep the price of gold in check. They wanted people to be afraid of holding gold over fiat Fed notes. They didn't want their fiat system to crash and burn. And they were, throughout 10 years, remember, Nixon cut in 1971. So by 74, they see the gold price do a 7-bagger. They're already freaking out. they're coming up with the derivative exchange where they can cut the price of gold and the interest, and then they lose control. And you got a situation where Paul Volcker's showing up every day at his office asking his support or his little minions what the price of gold is. The first thing that comes out of his mouth, what's the price of gold in the morning? So it's very important, obviously, the price of gold. And so look, at some point they're going to want to change the system. We can't keep running with this system. It's running on fumes. And so at some point they're going to allow gold to start really moving up. And the question is at the timing and kind of all the circumstances around that. But ultimately, look, the stock market has been running into, it's now a crazier mania than I would suggest it's crazier almost now than it was in the late 1990s. I mean, I was young when living through that, but like what's been happening of late on the stock market and what's been happening with the NASDAQ and just, all the tools that are being used now to pump up stocks and to ramp stocks one way or the other, up or down. SEC's got their hands cut out. I don't think they're actually going to be able to rein this in. And I think it could get much crazier because, look, the Federal Reserve's kind of painted themselves in a corner because the American U.S. citizens are such stock-loving idiots. They think the stock market is like the end-all, be-all. And look, to be honest, from the 80s onward, like they've been right. I mean, the system, if you look at like the S&P 500 from 1980 on till today, has been pro stocks. And so if you bought and held from the early 80s to now, you've done very well.
And even give us the example of Signal that you and I were talking about earlier.
Oh, yeah, right. I mean, if you're talking about ramps and crazy manias, I mean, just last week or 2 weeks ago, Elon Musk tweeted something about, people should switch from WhatsApp to Signal. And Signal is like a non-profit. It's not like they're owned by Facebook or anything like that. So the Signal that's part of their brand is to pitch the fact that they are kind of like a WhatsApp with all the tools that WhatsApp has, but they don't data mine you. They don't rape their customer base, et cetera, kind of like WhatsApp will and WhatsApp does. And so when that happened, all these people who were like, whatever Elon says, just buy it because it's going to the moon. They ran out and bought a stock that was called Signal, or somehow the name was associated, but it had nothing to do with Signal, the app on the phone. It was just a completely different business that was a publicly traded company that all of a sudden shot up just because the name, people weren't even doing any due diligence. They weren't even figuring out whether or not that was the right company. They just buy it and the price starts going up. So we have a situation where there's just so much loose money, loose currency in the Robinhood apps and in the trading accounts that you just have people willy-nilly buying based off of a tweet here or there. I mean, it's gotten really, really absurd. And like I said, it's going to keep going. I mean, for a long time because the Federal Reserve has painted itself in a corner in the fact that the baby boomers pretty much still have all their retirement locked into the stock market. So, but they would have a crisis on their hands if the stock market were to fall 80%, 90% like it did in the Great Depression. So of course they're going to run in like they did in March and April of last year and buy up everything that's not nailed down in order to keep supporting the especially the corporate bond market. That's a lot of the triple Bs, the companies that shouldn't be triple B. They have to support those the way things are looking to keep those companies propped up. So essentially that those companies can be held in pension funds, et cetera. If they fall out of triple B, it's a problem. So, it's basically, we have a situation where we're painting ourselves in the corner. The stock market has to stay up nominally. We got to figure out how to keep doing that. I'm sure the New York Fed's hard at work every day, keeping, everything looking nominally nicely. You have all these crazy small stories like the Elon Musk Signal story, like the GameStop story that's happening right now. And so you're in a mania essentially. And how long can this last? It can last for a lot longer, especially with the financial powers that be kind of backing it. So we could stay nominally propped up pretty high. I just think that ultimately underlying it all, I mean, there's a lot of people that know this is a joke. Like this market valuation is just ridiculous. And so they'll trade it just based on momentum, but they're just going to trade it as a scalp trade. They're not trading it for value. In true value terms, when I measure it by gold or silver, it's still way above where it was in 2011. And my thesis is simple, like where it went to 2011, we're going below that by the time this is over and done, probably well beyond that, probably toward the 1980 lows. That's how extreme this commodity bull that's going to probably get toward the end of this decade into next. So, you can bet, I think, with some of your position, some of your investment wealth, to know that gold and silver should outperform the stock market in the coming years and outperform it beyond the 2011 lows that are on those charts. And that's to me, it's an easy bet. A lot of times I look on those long-term charts and I say, okay, well, where did it bottom in 2011? Okay, well, we're going beyond that because look how ridiculous what we've done since. It's obviously we have a lot of fuel that's going to blow it beyond the 2011 level. And so making those bets is a safe play. I don't feel like I'm hyperbolic if I tell you, look, 2011 is not how low it's going to get. It's going to go beyond that. So.
And I think another point that kind of illustrates this is the recent behavior of the corporate executives, and what does that do? What does that mean for the markets?
So you were
highlighting this recently in a tweet. So
last week, I just stumbled on it. Charlie Munger at the end of 2020 was talking about how he's pessimistic about how the 2020s is going to go for stock returns versus where they are now. He was just basically ranting. I mean, anyone who knows who Charlie Munger is, he's like the partner of Warren Buffett at Berkshire, and I'm sure he's a billionaire, and he's made a lot of wealth out of the stock market since whenever he got involved, probably in the 50s all the way to today. He's an older guy. He's in his 90s, kind of a curmudgeon, and basically stating like, look, we're in a crazy mania right now, and he admits the fact that obviously the stock market's probably being propped up and it could get crazier, et cetera. But the bottom line is if you look at the incentives for a lot of these executives at these corporations are to have the stock prices go up. And that's how they get their interest and make a lot of wealth, is if the stock price goes up. So you had, obviously in 2010s, you had a huge situation of buyback that happened, which used to be illegal, but now companies can buy back their own stock. And by doing that, they can artificially push up the price and make it look like, the value of the company's going up. Where in actuality, the shares outstanding are just shrinking is all that's happening. So you have a situation where you can have a melt up in stocks, et cetera. And those people who are executives can make a lot of wealth doing that. I mean, that's how a lot of new wealth is generated. I don't know if people understand, like, to go from like having no wealth to $10 million, the fastest way to do that is either be like an athlete, like a star, a sports person, entertainer, or like a company executive who, gets in and rides up high stock valuations and sells out. And so to see the chart last week where you saw the highest level of insider sales versus insider buying of stocks in the last 33 years, it's not surprising. It shows the fact that the people who are running these companies know that the price of their shares is way too high and that they should take some money off the table. That's essentially what's happening. They're not buying it, they're selling it. And so, that's what happens in the top of the market. The people who have the inside knowledge, they typically end up selling to the people who are FOMOing in, who are running in, trying to get a piece of all the greed that's going on. And, there's a huge wealth transfer. And that's basically what's been happening is you see this stock market has become a huge wealth transfer mechanism for the insiders. And, right now the Federal Reserve has been helping to keep it propped up. But at some point, I think in real terms, it's going to be dropping precipitously against gold and silver. And they may be able to reprop it up, nominally make everything look okay so they don't have a crisis with boomers, having to eat cat food and dog food. But the bottom line is I just think gold and silver is an easy bet given the fundamentals of what's happening.
Mm-hmm. So when considering investing in precious metals, what role could platinum play in a portfolio?
So platinum right now is, first off, it's extremely rare, and it's used in a lot of different things that are high tech involved. So we have a lot of situations where electronic vehicles, it could be used a lot more. And depending on if it's electronic vehicles or if hydrogen gets used a lot in Asia coming up, there's a lot of push toward, cars that are going to be running on hydrogen. And that requires a lot of platinum in those cars. So we have a situation where the supply in platinum is very limited, and the amount of work that's gone into actually developing new mines and such has not been happening. And so we have a situation of dwindling supply year in, year out. The supply is kind of peaked in the amount of platinum that's coming to market. The highest amounts of platinum used to come in, I think they happened around 2008, around the time when platinum last peaked, just over $2,000 an ounce. And so precipitously, we've had less supply of platinum, and the price is roughly half of its all-time nominal high right now. It's at $1,100. If you go back and look last 100 some odd years of data of gold versus platinum pricing, I mean, we literally didn't have a high platinum price versus gold until we figured out how to use it. In order to melt platinum, you have to have furnace hot enough to even melt it and to understand the physics of it. We didn't even get smart enough to figure that out until like the 1920s 20s, 30s. So what you see is when that started to occur and people started to understand, the characteristics of platinum, how to use it, the price of platinum actually got higher than gold. And typically throughout the 20th century, the price of platinum was higher than gold. It's rare that gold is higher than platinum. Right now, gold is almost twice the price of platinum. And that is a rarity. That's something that we've not seen in the last, 120 years of this data. And what my case here is that I think platinum, everybody knows the trope. I mean, there's less platinum than gold, and there's a lot less platinum than gold. Over in Asia, there's a lot of wealthy people who buy platinum jewelry, and in Japan and in China, they'll continue buying platinum jewelry because they'll look at the gold price and they'll look at platinum and they'll see the value at these price points. And the fact that, scientifically, platinum is just a little bit, the physics of the metal itself lend itself to being used in a lot of things, high-tech things that'll be coming out in the coming decades. Stuff that's not even been invented yet. I'm sure that there's going to be a demand for platinum because it just doesn't react. It's one of these metals that doesn't react, and you can use it in very, very high temperatures, which is going to probably be needed to build energy and to do things that are more green interested. So my betting here is that we're walking into a huge commodity bull market toward the end of this decade, into the 2030s. Platinum at this price is $1,100. Ultimately, it'll go beyond its old nominal high of $2,200. And by the end of this precious metal bull market, all four precious metals, I think, will be hitting new nominal price highs and hitting an exponential curve where they go up where on a chart, it starts to look like this for all of them. Mm-hmm. And so, the future for platinum is my guess is that it will gap closer toward gold and it'll eventually get back in parity in line with the historic norms. So if you look at platinum in terms of a play for precious metals, it would be something that you would bet on to play out in the next decade or two. It's going to take a while, but it's at these prices, I think $1,100 platinum, you'd look back 4 or 5 years from now and be like, well, that was good value. I'm glad I bought that. It's a long-term store value. And then once platinum starts getting into really bonkers levels, new record price and new values, then you sell it off for something and you buy some other cheaper asset class. It's not something, I'm not saying platinum's money or platinum is this or that. I just think it's cheap right now in terms of how much is available in the world. I mean, literally a couple billionaires could corner that entire physical market if they wanted to. It's really tiny.
Interesting. Perfect, James. Well, as we wrap up here, do you have any concluding thoughts you'd like to share with us?
Yeah, I just think that it's hard. I try and tell myself every day, like we have to be patient in terms of if you've been watching the charts, I'm sure your listeners have been too. At the beginning of the year, when the two senators won in Georgia, and all of a sudden it's like full Democrats now in the executive, legislative branches, et cetera. So you have Congress, the Senate, the executive branch too. They're all Democrats. So it looks like there's going to be a lot of currency easing coming, a lot more M2 supply going to be growing, a lot more Federal Reserve monetization where they're refinancing and just simply buying their own debt outright. We are on the cusp of huge things for the precious metals market. So I know it's annoying to see them come in and rig the price like they did right after that win. That was one of the most egregious spot price paint jobs I've ever seen. But the fact that we're here moving sideways at 1850 in gold, moving sideways at 26 in silver. 26 is a huge, important number for silver. Mm-hmm. If you look at the long-term charts, look at what silver does when it gets beyond 26 and gets moving. I mean, we could literally be days away from this thing starting to move, starting to go to a 30 and beyond. And then once it gets beyond 30, it's going to be very exciting times for silver. So my suggestion would be, A, if you're not positioned, get moving. And B, if you are positioned, just hold tight because we're about to get moving. I mean, it really is. We are on the cusp of some amazing times for silver and gold. So hang in there.
Excellent, James. That's some great advice. As always, we can find you on Twitter at JamesHenryAND, at silverbullion.com, and also your YouTube channel, SD Bullion.
No problem. So you can find it at sdbullion.com, at James Henry and Twitter. Those are the two best. And go to the YouTube SD Bullion channel. I update a weekly video on there every week. You can subscribe there. And typically at the end of every Friday, I put like a 10-minute video out kind of describing what's been happening in the market that week or looking at charts, et cetera. So it's totally free. So if you find value in that, then come along and subscribe.
Excellent. Thanks very much for your time today, James.
Thanks, Tom. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.